Welcome to Supernova Stock Watch. In this video we are going to discuss 7 high-yielding covered call ETFs to consider in 2022. Covered call strategies are a great way to get solid returns while avoiding the uncertainty involved with other investments. While everything right now is still somewhat stagnant and yields for long-term bonds and stocks are very low, covered calls offer an opportunity to see 10% or higher returns right now. If you are looking for higher returns, look into junk bonds or penny stocks that are riskier. With the Fed looking to tighten policy and the economy foreseeing a slowdown, this is a much more careful time to add risk to your portfolio. Covered calls can be a great way to maximize your income when share prices aren't exactly rallying higher. Of course, those high yields come with a trade-off. Investors who write calls spend time waiting for the stock price to get called away in order to earn premiums, but will miss out on much of the capital gains. If you were expecting a sideways or even slightly declining market, covered call strategies could be a way of outperforming on total return basis or just earning an admittedly double-digit yield. The ETF industry has more than a dozen funds to choose from. Global X is by far the biggest issuer of these products, but several fund companies have jumped in to offer some relatively unique strategies that could prove to be beneficial to investors in 2022. Starting out, we are going to look at Global X Nasdaq 100 Covered Call ETF, ticker QYLD. QYLD is easily the largest covered call ETF out there, which shouldn't be surprising given that it uses the Nasdaq 100 as its core index. The fund's strategy is very straightforward. It buys all individual index components in the same weighting to effectively mimic the Nasdaq 100, and then writes a series of at-the-money options on 100% of the portfolio's assets in order to maximize income. Here's the upside. QYLD currently yields more than 12%, making it one of the highest yielding ETF choices out there. It also pays dividends on a monthly basis, making it incredibly convenient for investors looking to live off of their portfolio income. Here's the downside. Because options are written over 100% of the portfolio, you're essentially giving up most if not all capital growth upside. That's easy to see looking at the chart where the share price has peaked around the $23 to $24 level even as the Nasdaq 100 has pushed to new highs. If you're a believer that the Nasdaq 100 is moving sideways or even slightly down over the next 12 months, QYLD could be a nice option for investors. The second most popular is Global X, S&P 500 Covered Call ETF, ticker XYLD. This ETF is effectively the same as QYLD, except it uses the S&P 500 as its core index instead of the Nasdaq 100. It currently yields a comparatively more modest 8%. That could be expected since the S&P 500 is generally considered less volatile than the S&P 500, and lower volatility tends to equate to lower option premiums. XYLD has been a little unusual in that it's been able to capture share price gains in addition to the high yield. The market environment coming out of the COVID recession has been unusual to say the least, and I wouldn't expect this trend to continue, since it also uses a 100% option overlay. Overall, even though the yield is lower, XYLD could be preferable to QYLD if you want a little less tech exposure in your portfolio. Now coming in third is the Global X Russell 2000 Covered Call ETF, ticker RYLD. This covered call ETF option uses small caps instead of large caps. RYLD is the only ETF out there writing call options over a small cap portfolio, so it's a bit of a unicorn. Its 12% yield is more in line with QYLD than XYLD for the reasons mentioned already. Higher risk levels tend to come with higher income premiums. As we've already seen over the past month or two, that risk can be a problem. Small caps have been declining and RYLD has declined with it. The yield is certainly attractive, but these covered call ETFs can experience share price declines along with their indexes under the wrong conditions. Look no further than the first quarter of 2020 to see what can potentially happen. Continuing to look at the different ETF options Global X has to offer, the last one that might interest you is Global X Nasdaq 100 Covered Call and Growth ETF, ticker QYLG. QYLG is interesting in that allows for more share price growth potential in exchange for a lower yield. Whereas QYLD writes options over 100% of the portfolio, QYLG writes them over just 50%. Its current forward-looking distribution rate is around 6%, roughly half that of QYLD. QYLG as well as the Global X, S&P 500 Covered Call and Growth ETF, XYLD, offers a nice middle ground between the underlying index outright and investing in a full-out covered call option strategy. Now looking beyond the popular Global X ETF products, you may find interesting is Amplify CWP Enhanced Dividend Income ETF, ticker DIVO. DIVO is unique in both how it takes a quality approach to portfolio construction and uses a tactical strategy to determine where and how to write call options on the portfolio. The fact that it's actively managed also provides an advantage in that it allows the management team to pivot quickly should conditions change. Divo's portfolio consists of roughly 20 to 25 stocks that have histories of both dividend and earnings growth and are adjusted according to market cap, management track record, earnings, cash flow and return on equity. On top of that portfolio, covered calls are written against individual stock positions on a tactical basis looking for the most attractive opportunities. Divo aims to deliver a yield of between 4 to 7%, which is a combination of dividend income and options premiums. As of the latest semi-annual update, Divo had options written against just 2 stocks, Apple and Nike. It has a distribution yield of nearly 5%. If you're a fan of the Aristocrats dividend stocks, you may be interested in the FTSE Bovest S&P 500 Dividend Aristocrats Target Income ETF, ticker KNG. KNG is an interesting option if you're interested in using dividend growth stocks as a key part of your income strategy. This fund starts with an equal weighted portfolio of the stocks contained in the S&P 500 Dividend Aristocrats Index and then issues a rolling series of written call options on each of the Aristocrat stocks. Its primary objective is generating an annualized income from stock dividends and option premiums that is approximately 3% over the annual dividend yield of the S&P 500. As of right now, it's coming a little short of that goal, offering a distribution yield of around 3.6%. This is a nice option for capturing a much higher yield from a very popular investment strategy. Another option is the Invesco S&P 500 Buy Right ETF, ticker PBP. PBP is essentially Invesco's version of XYLD. It also lays a covered call writing strategy over the entire portfolio. The only major difference I see is that PBP will write options with strike prices at or above the prevailing S&P 500 prices, where XYLD targets at the money options contract specifically. That difference could account for why XYLD yields 8% and PBP yields closer to 6%. The difference, though, has allowed PBP to capture somewhat higher share price returns over the past couple of years as well. I enjoy sharing my insight with you and helping both of us become a better trader and investor and finding some level of success. Let me know what cover call option ETF interests you the most. You have made it to the end of my video. Thank you for watching. Please check out my other videos. See you next time. Peace.